Most people don't think about the dollar when they wake up. They think about rent, groceries, gas, insurance. They think about why everything feels more expensive, even when the news says inflation is coming down. And that gap, the one between the official numbers and what you actually experience, isn't a mistake. It's a direct result of how our financial system works, quietly, in the background. This story doesn't start with a market crash. It doesn't start with widespread panic or a political scandal. It starts with something much more fundamental: incentives. The US dollar, the money in your bank account, plays two very different roles at the same time. At home, here in the US, it's the ruler we use to measure everything: our wages, our savings, our debts, and what we can buy with the money we earn. But on the global stage, the dollar is the anchor for the entire world's economy. It's used for international trade, held as reserves by other countries, and it's the currency for pricing essential commodities like oil. The problem is, these two roles often clash. What's needed to keep the global system stable doesn't always protect your purchasing power here at home. And the policies that make our national debt manageable don't always feel good when you're standing at the grocery store checkout. This tension has always been there, but what's different now is the sheer scale of it all. We are living in a time of historically high debt. Not just government debt, but corporate debt, household debt like mortgages and credit cards, and all of it is led with complex financial instruments. This isn't a political argument, it's a simple balance sheet reality. And as that mountain of debt grows, our entire economy becomes incredibly sensitive to interest rates. Even small changes in rates have massive consequences. The cost of making a policy mistake goes way up, and the pressure on the system builds faster and faster. When a system gets this strained, there are only a handful of ways to release that pressure. You can raise taxes. You can cut government spending. You can allow defaults to happen, where businesses or even governments fail to pay their debts. Or, and this is the one nobody talks about openly, you can adjust the value of the money itself. This last option is the most flexible tool a government has. A slightly weaker currency does a few very specific things. Over time, it slowly reduces the real value of all that existing debt, making it easier to pay back. It can help American companies sell their products abroad. It helps keep asset prices like stocks and real estate from collapsing. And most importantly, it absorbs economic stress without requiring politicians to make painful, unpopular decisions. Now, this doesn't mean anyone sits in a room and decides to destroy the currency. That idea completely misses how policy is actually made. What really happens is a process of prioritization. Policymakers choose to create stability in one part of the system, fully knowing it will create pressure somewhere else. For example, they might prioritize keeping the financial markets from freezing up, even if that means the dollar loses a bit of its value and your groceries get more expensive. This trade-off isn't an accident. It's a structural feature of the system we have. This is why getting caught up in whether the dollar is strong or weak misses the bigger picture. The dollar isn't weak. It's being used. It's a tool, a lever being pulled to manage these immense pressures. You can see this in the way central bankers talk. They rarely mention currency targets directly. Not because the dollar's value doesn't matter, but because where the dollar ends up is a result of their other actions, not the main goal itself. When the global system needs more liquidity, central bank balance sheets expand. When financial stress pops up somewhere in the world, emergency swap lines appear to provide dollars. The value of the currency moves as a consequence of these actions, not because of a press conference announcing a new currency policy. This is where a lot of people get confused. They see the Federal Reserve pause interest rate hikes or soften its language, and they assume the goal is just to boost the economy or help out a political party. But in a system as leveraged as ours, policy isn't primarily about creating growth anymore. It's about preventing fractures. It's about keeping the system from breaking. Growth is a nice bonus, but stability always comes first. History shows this pattern repeating itself. In the 1970s, huge government spending led to policies that created runaway inflation. In the 1980s, after the dollar had become unsustainably strong, the world's major economies coordinated to bring its value back down. Different decades, different problems, different tools. But the underlying logic was exactly the same. Pressure builds, and an adjustment has to follow. Today, our global financial system is more interconnected than ever before. This means the adjustments don't have to be dramatic to have a huge impact. A change of just a few percentage points in the dollar's value, small shifts in the interest rates between countries, subtle changes in where big investors are putting their money. These aren't the kind of things that make front-page news. They're quiet signals. And they almost always appear before the real stress becomes obvious to everyone. This is why focusing on presidents and politicians misses the real story. Presidents change, administrations come and go, but the fundamental incentives don't. The debt is still there. The demographic trends are still there. The global economic imbalances are still there. Policy will always adapt to these powerful, underlying realities, regardless of who is in office. So in this context, an environment where the dollar gradually loses some of its purchasing power isn't a mistake. It's not a sign of collapse, and it's definitely not some grand conspiracy. It is simply one of the only pressure valves left in a system that is carrying decades of accumulated strain. It's an adjustment. And these adjustments never happen in a vacuum. When the value of the dollar shifts, other things move with it, and sometimes they move first. Other currencies react. The prices of commodities like gold and oil respond. And huge pools of capital start to quietly reposition themselves for what's coming next. These movements don't explain the system. They reveal it. They show us how it's working under the surface. And that's where the real story is. Not in the headlines. Not in the bold predictions of gurus. But in the quiet movements of assets and the shifting relationships between them. They are the signals that tell us what is happening long before the stress becomes visible to all. And if you learn to watch them, you can see the future taking shape. Thanks for watching. When large systems adjust, they rarely do so in isolation. Pressure released in one area almost always shows up somewhere else. That's why watching the dollar alone is never enough. You have to watch what moves alongside it, and what tends to move ahead of it. Those movements don't predict the future. They reveal how stress is being redistributed. One of the first places this redistribution appears is in global currency relationships. Not headlines. Not speeches. Relative movements. When yield differentials change, capital responds. When funding conditions tighten, currency volatility rises. And when stress becomes global, coordination, formal or informal, begins to matter more than rhetoric. This is not new, but it is accelerating. Look at the behavior of currencies that sit at the center of global funding. The dollar, the yen, the euro. These currencies don't just reflect national economies. They reflect balance sheets, leverage, and global liquidity preferences. When those relationships shift, something deeper is happening. Take the Japanese yen. For decades, it has played a unique role in global markets. Low yields, stable funding, a cornerstone of carry trades. That structure worked as long as volatility remained contained and interest rate differentials stayed predictable. But when global rates rise sharply, that balance becomes fragile. Funding currencies feel stress first, not because of headlines, but because of math. When authorities step in to smooth volatility, it's rarely framed as a signal. It's framed as stability management. But intervention itself is a message. It tells you volatility is no longer self-correcting. It tells you pressure has reached a threshold where market mechanics alone aren't enough. That doesn't mean a crisis is imminent. It means the system is working harder to maintain order. Another place where these signals appear is in commodities, especially those that have historically responded to monetary conditions rather than industrial cycles. Gold sits at the center of that category, not because it predicts events, but because it reacts to monetary stress before it becomes visible elsewhere. Gold doesn't move because of fear headlines. It moves when real yields shift, when currency credibility is questioned, when the opportunity cost of holding liquidity changes. In other words, gold responds to incentives. Quietly. When gold prices rise in an environment where inflation appears contained, that disconnect matters. It doesn't mean inflation statistics are fake. It means markets are responding to something broader than consumer prices. They're responding to balance sheets, to debt sustainability, to long-term purchasing power. Gold doesn't tell you what will happen. It tells you what the system is pricing in. Silver often follows the same logic, with more volatility. It sits between monetary signaling and industrial demand. That makes it less precise, but often more sensitive. When both metals move together, it's rarely about short-term news. It's about confidence in the framework itself. Another signal appears in how capital reallocates globally. When investors become less confident in the stability of returns, they don't rush to cash alone. They reposition. They shorten duration. They diversify currency exposure. They favor assets that are less dependent on continuous liquidity expansion. These shifts don't make headlines, but they reshape markets over time. This is why large adjustments often feel invisible at first. Nothing breaks. There is no single moment of panic. Instead, friction increases. Liquidity becomes selective. Volatility clusters. Intervention becomes more frequent. The system still functions, but less smoothly. This environment confuses people because it doesn't look like past crises. There's no obvious collapse. No universal sell-off. No clear villain. Just a sense that stability requires more effort than it used to. That's not accidental. Highly leveraged systems can absorb stress, but only if pressure is constantly redistributed. Currencies help do that. Asset prices help do that. Policy flexibility helps do that. Each adjustment buys time. But time is not free. This is where the misconception of strength becomes dangerous. A system can appear stable while becoming more fragile underneath. Volatility can be suppressed while imbalances grow. Liquidity can flow while confidence erodes. These contradictions aren't failures. They're features of late-stage complexity. None of this implies inevitability. There is no date on a calendar. No countdown clock. But there is a direction of travel. More intervention. More management. More reliance on policy tools to maintain order. Less spontaneity. Less margin for error. Understanding that doesn't require predicting a collapse. It requires recognizing signals. Currencies that move in coordination. Commodities that respond ahead of data. Capital that behaves defensively before fear appears. These are not warnings of disaster. They are indicators of strain. The dollar doesn't need to collapse for this story to matter. It only needs to adjust. And those adjustments, small, technical, often unnoticed, shape the environment everyone lives in. From purchasing power, to asset prices, to financial stability. That's why the dollar isn't weak by accident. And why watching markets quietly often tells you more than watching headlines loudly. If you want to understand how the system is changing beneath the surface, not just react to what already happened, this is where the signals appear. Not in noise, but in what moves first.